To invest successfully over a lifetime does not require a stratospheric IQ, unusual business insights, or inside information. What's needed is a sound intellectual framework for making decisions and the ability to keep emotions from corroding that framework. This is a timeless quote from The Intelligent Investor by Benjamin Graham, and to date, no truer words have been spoken. Making the wrong investment decisions can feel like a catastrophe, and making the right ones can be life-changing. So, how do you make your first $1 million by making the right decisions? Hello, viewers. Welcome to another episode on Brainfield. Today, you just might learn a new thing or two on how to make your first $1 million. Don't forget to subscribe to the channel and click on the post notification icon to get more videos like this. Let's get right into it. We will be looking into one of the greatest investment books of all time by Benjamin Graham, The Intelligent Investor, and taking important lessons learned per chapter. Chapter 1: Investment versus Speculation. Results to be expected by the intelligent investor. For an intelligent investor, money isn't made by simply following the market. Benjamin Graham argues that stocks become riskier the more their value increases, and vice versa. Unlike the speculator, the intelligent investor isn't investing for quick wins. The only way to reach long-term investment goals is to make sustainable and reliable decisions. Chapter 2: The Investor and Inflation. To understand inflation, we have to look at how it has fluctuated throughout time. While interest rates do oscillate, the overall trend is that interest generally increases over time. Forecasting what the interest rate is going to look like in the future is risky, but it might be worth considering the interest rates of the previous 20 years and using them as a springboard to forecast what might be probable in the future. Chapter 3: A Century of Stock Market History. The Level of Stock Prices in Early 1972. In this chapter, Benjamin Graham argues that investors should not rely exclusively on historical data to predict the future. As Graham points out, to use a market's recent good returns as a platform from which to project future returns is risky. No stock can perform consistently well for all time. Instead, he suggests we use the rule of opposites, which suggests that the more enthusiastic investors become about a stock option, in the long run, the more certain they are to be proved wrong in the short run. Chapter 4: General Portfolio Policy. The Defensive Investor. The aggressiveness of your portfolio is more a function of your investing style than it is of the kind of assets you make. According to Benjamin Graham, there are two ways to be a wise investor. Number 1, to continuously investigate, choose, and monitor a mixture of bonds, mutual funds, and equities. This is known as the active or enterprising method, according to Graham. It takes a great deal of time and effort. Number 2, to establish a long-term portfolio that requires little additional work from you, runs automatically, but lacks many thrills as a result. This is what Graham refers to as the passive or defensive strategy. Both strategies are intelligent, but to succeed in either one, you must understand which one suits your personality better. Chapter 5: The Defensive Investor and Common Stocks. Why would a defensive investor ever invest in stocks as opposed to bonds? Due to the risk of inflation, to invest entirely in either stocks or bonds is to make yourself vulnerable. The more familiar an individual feels they are with the subject, the more likely they are to exaggerate how much they know about it. This phenomenon can be seen in the likes of investors buying shares in Amazon.com simply because they frequently used its services. Researchers at Carnegie Mellon University showed that these investors failed to see that the stocks they were buying were overpriced. Number 6. Portfolio Policy for the Enterprising Investor. Negative Approach. According to Benjamin Graham, what you don't do is just as essential as what you do for both defensive and aggressive investors. Graham emphasizes a few essentials in this chapter for individuals looking to follow the path of an aggressive investor. These include: Number 1, avoid high-yield preferred stock since there is no easy and accessible way to reduce the risks involved with such stock. Number 2, avoid becoming trapped in a vicious cycle of constantly buying and selling equities in response to market swings. The more you trade, the less you keep, as proven by the thousands of individuals who have fallen victim to this exaggerated brand of aggressive investing. Chapter 7, Portfolio Policy for the Enterprising Investor, the Positive Side. According to Graham, an aggressive investor will invest in 4 different ways. A. Buying in low markets and promoting sales in high markets. B. Buying growth stocks after thorough consideration. C. Purchasing discount stocks. D. Taking advantage of unique situations and supporting them. Furthermore, for an aggressive investor to make a wise investment, it must be held to the following 2 standards. Number 1, sound reasoning must be used to support the stock purchase choice. And number 2, it must not be well liked by the majority of other speculators or investors. Chapter 8: The Investor and Market Fluctuations. The intelligent investor pays too much for stocks when they are doing well and tries to get rid of them when their price falls. Benjamin Graham says the market is a fallible, emotion-driven entity that shouldn't be blindly trusted. The intelligent investor should behave in a way that serves their interests without getting caught up in the pull of dramatic market fluctuations. The stock market is the best option for a lifelong investment. By putting your portfolio on autopilot, you can avoid the mood swings of Mr. Market and can focus instead on your long-term financial goals. Graham states that it would be better if we couldn't see a market quotation for our stocks at all. Chapter 9: Investing in Investment Funds. The intelligent investor must choose carefully before investing in a mutual fund. Mutual funds do not choose stocks well enough to cover the costs of researching and trading them. Graham and Buffett both agree that index funds are the single best choice for individual, intelligent investors. In general, an index fund that owns all the stocks in the market will beat the most selective funds in the long run. Chapter 10: The Investor and His Advisors. An advisor can be a valuable tool in the toolbox of the intelligent investor. According to Graham, there are some circumstances in which consulting an advisor can be even more advantageous. Before selecting an advisor, you must first determine whether you can trust them. After that, you must look into and confirm their credentials. Chapter 11: Security Analysis for the Lay Investor. It can be challenging to discern which factors determine whether you should be willing to pay for a stock or not, but Graham provides 5 qualities by which to measure the attractiveness of a stock option, of which the most important is, if dividends have increased at least 6 to 7% over the past 10 years, that's a good sign. Chapter 12: Things to consider about per-share earnings. The intelligent investor is aware of the lengths to which top executives and accountants go to make themselves very rich at the expense of the company and its shareholders. A pro forma statement might show how much a company could have made over the previous year if the company they just acquired had been with them for that entire year. Pro forma earnings can also be used in a more corrupt manner, with companies showing how well they might have done if they hadn't made such bad investment decisions. There are a few things the intelligent investor can do to try to ascertain whether a company they are about to invest in has a few red flags in its accounting methods. And they are: Number 1, read the company's financial report from the back. That's where the dirt they won't want you to find are. Number 2, read the footnotes and be sure to compare. And number 3, read more so you won't be misled by a dubious earnings statement. Chapter 14: Stock Selection for the Defensive Investor. By definition, the defensive investor takes a low-risk, long-term approach to investment. Graham proposes the following criteria for stock selection. Number 1, adequate size. Graham advised against investing in smaller companies when he initially wrote The Intelligent Investor. However, it can also be financially advantageous to invest in smaller companies through a small company index fund now that it is possible to purchase mutual funds that are focused on tiny equities. Number 2, strong financial situation. According to Graham, a diversified stock portfolio has financial strength if its current assets are at least twice as large as its current liabilities and its long-term debt is not greater than working capital. Number 3, earnings stability. If a firm has generated some earnings on its common shares during the past 10 years, it is strong. Number 4, dividend record. Look for businesses that have a history of paying dividends. Chapter 15: Stock Selection for the Enterprising Investor. For most investors, picking individual stocks is inadvisable. Even most professionals do a lousy job. The majority would do better to invest defensively in an index fund. Graham suggests spending a year tracking and picking stocks, but not investing any money. After a year, measure your results against how you would have done if you had invested in the index fund. If you enjoyed the process and made some good returns, Graham suggests assembling a selection of stocks, limiting them to only 10% of your entire portfolio. Chapter 20: Margin of Safety as the Central Concept of Investment. Graham suggests that the greatest risk to our financial health isn't the stocks, but ourselves. According to the Nobel Prize-winning psychologist Daniel Kahneman, we often fall prey to two modes of thinking when making a decision: well-calibrated confidence and correctly anticipated regret. Consider asking yourself the following questions. What is my track record with making similar decisions? What is the track record of other people who've made similar decisions? If I am buying, it means someone else is selling. How probable is it that I know something that the seller doesn't know? The probability of you making a bad investment during your investment lifetime is 100% guaranteed. Many investors are so sure that they are right that they do little to protect themselves against the consequences of being wrong, and this is fatal for an investor. By making sure your portfolio is permanently diversified and that the fluctuations of the market never influence you, you can ensure that the fallout from your bad investment decisions will never be a total disaster. To close off this episode, we leave you with another timeless quote from the book. Although there are good and bad companies, there is no such thing as a good stock. There are only good stock prices, which come and go. Head on over to the comment section and leave a comment. Don't forget to share with your friends. See you next time.